April 2026 is here, and if you're counting on Social Security this month, there are a few things happening right now that could quietly change what actually lands in your bank account, and most people won't find out until it's too late. Welcome back to Senior Benefits Hub. I'm Sabine, and today we're walking through everything you need to know about your April payments, the exact dates, what's changed, what's still shifting, and honestly, what the system isn't making very obvious right now. Because here's the thing, more than 70 million Americans are receiving Social Security or SSI at this moment. That's not a small number. That's a massive portion of the country depending on these payments to cover real expenses, groceries, prescriptions, rent, utilities. And when even small changes happen inside that system, the ripple effect is immediate and personal. So we're going to break all of it down today. The April schedule first, then the updates that are either helping people or creating new friction. And finally, the bigger picture that nobody really wants to talk about, but that everybody probably should. If you've been with this channel for a while, you know we don't sugarcoat things here. We tell you what's actually going on so you can make smarter decisions with your money and your time. Let's get into it. Starting with SSI, Supplemental Security Income, April is actually a cleaner month than what we've seen recently. If you receive SSI, your April payment is scheduled to arrive on Wednesday, April 1st. No early deposit, no rollover from the previous month, no confusion about timing. It lands right on the 1st, which is exactly where people expect it. Now, that might sound completely unremarkable, but after several months of shifted payment dates and early deposits that threw off budgeting for a lot of people, a straightforward deposit date is actually something worth noting. So, if you've been doing mental math trying to track when money's coming in, April is giving SSI recipients a clean, predictable date to work with. Now, here's a question worth sitting with for a second. When you look at what's hitting your account versus what you're actually spending each month, do those two numbers feel balanced right now? Or does it still feel like you're constantly playing catch up? Keep that in mind as we go through the rest of this because there's a piece coming up that speaks directly to that feeling. Moving on to Social Security payments, let's get specific. If you began receiving Social Security before May of 1997, or if you currently receive both Social Security and SSI at the same time, your April payment is scheduled for Friday, April 3rd. That date applies to you specifically, and it should already fit into your expected routine if you've been tracking your deposit pattern. For everyone else receiving retirement, survivor, or disability benefits through Social Security, your payment date is tied directly to your birthday, specifically the day of the month you were born. This system has been in place for years, and it remains unchanged in April. If your birthday falls between the 1st and the 10th of any month, your April payment arrives on Wednesday, April 8th. If your birthday falls between the 11th and the 20th, your payment is scheduled for Wednesday, April 15th. And if your birthday falls between the 21st and the 31st, you're looking at Wednesday, April 22nd. Most payments come through direct deposit, and they typically process overnight or in the early morning hours. Some banks, depending on how quickly they post transactions, may show the deposit a little later in the day or even the following morning. That's normal. Social Security generally advises waiting at least 3 business days before calling to report a missing payment, especially if a holiday or weekend is involved. So, don't panic if it's not there at sunrise. Give it a little breathing room first. All right, so now that you know when the money is coming, let's talk about how much and whether it actually feels like what was promised, because this is where it gets interesting. The 2.8%, 8% cost of living adjustment for 2026 went into effect at the start of the year. By now in April, you've had a few months to see it in your actual deposits. On paper, the average increase works out to somewhere in the range of $50 to $60 more per month for many retirees. And when you hear that number announced, it sounds like meaningful relief. But here's the part that a lot of the official announcements gloss over. For people enrolled in Medicare Part B, which is a significant portion of Social Security recipients, those premiums are deducted directly from your Social Security payment before it ever reaches your account. And right now, Medicare Part B premiums are sitting at roughly $200 a month for many beneficiaries. When you subtract that from your gross benefit, the actual amount hitting your bank account may have gone up by far less than $50 or $60. For some people, depending on their exact benefit amount and premium tier, the net increase feels almost invisible. So if you looked at your deposit in January or February and thought, Wait, I thought my benefit went up. You weren't imagining it. The gross amount did increase, but after Medicare takes its share, what's left might not feel like much of a difference at all. And this connects to something even bigger that we'll come back to in a few minutes. But first, let's talk about a change that's been unfolding quietly on the operational side of Social Security. One that isn't about your benefit amount at all, but that could absolutely affect your experience dealing with the agency this month and going forward. Earlier this year, the Social Security Administration began a significant shift in how it handles casework and public interaction. Rather than routing most requests through local field offices, the kind you could walk into and talk to someone face to face, the agency has been moving toward a more centralized, nationally managed system. This means more reliance on online portals, automated phone systems, and processing that happens behind the scenes rather than through a person at a desk in your community. From the administration's perspective, this makes sense as a cost and capacity decision. The number of people receiving benefits has grown substantially, and staffing at local offices has not kept pace with that growth. So the agency is trying to serve more people with the same or fewer resources, and centralization and automation are the tools being used to do that. But here's what that means on your end, especially if you prefer speaking with a real person or have ever relied on a local office to sort out an issue. Wait times for phone assistance have stretched considerably longer in many areas. Automated systems are handling more of the initial screening and routing. And getting a specific answer to a specific question has become more complicated for a lot of people who need straightforward help. So while your payment will still come in on schedule, if you need to contact Social Security about anything this month, a question about your record, a change in circumstances, an issue with your payment, build in extra time. Don't assume a quick call will resolve things quickly because that's not the experience many people are having right now. Now, let me shift to something that has genuinely helped a meaningful group of people. And if you fall into this group, you may have already seen the impact in your recent checks. For years, two specific rules reduced Social Security benefits for certain public sector workers. The windfall elimination provision and the government pension offset affected teachers, police officers, firefighters, and other government employees who receive pensions from jobs where Social Security taxes weren't collected. Under those rules, their Social Security benefits were reduced, sometimes by hundreds of dollars a month, even though they had also worked in Social Security covered jobs at other points in their careers. Both of those provisions have now been eliminated. For the people affected by this change, the difference is real and substantial. Some are seeing increases of several hundred per month in their ongoing benefits. On top of that, many are receiving retroactive payments, meaning back pay for the months when their benefits were reduced under those old rules. If you or someone you know worked in public service and was subject to either of those provisions, this is absolutely worth looking into because the correction may already be in process. Here's a question I'd like you to think about, and you don't have to answer it out loud, but think about it. Have you or someone close to you ever felt like you paid into a system for decades and got less out of it than you were owed? Because for a lot of public workers, that's exactly what was happening, and it's now being corrected. But here's the part of this conversation that tends to make people uncomfortable. So let's just go ahead and address it directly. All of these changes, the cost of living increase, the elimination of those two provisions, the operational shifts at the agency, they're all happening against the backdrop of a larger financial question that keeps resurfacing. How long can the current system sustain itself? Current projections based on the Social Security Administration's own reporting and independent actuarial analysis suggest that the primary trust fund supporting retirement benefits could reach depletion sometime in the early 1930s, with many estimates landing around 2032. And that's roughly 6 years away. And the important clarification here is that depletion does not mean the program disappears. Social Security collects payroll tax revenue continuously, so payments would continue. But if the trust fund runs dry and nothing changes before that point, benefits could be cut by roughly 25% across the board. To put that in real numbers, if you're currently receiving $2,000 a month, a 25% reduction would bring that down to $1,500. That's $500 a month less every single month, with no corresponding decrease in your rent, your groceries, or your medication costs. Now, is that outcome locked in? No, There are active legislative discussions happening around several different approaches to shoring up the program's finances. Some proposals involve raising or restructuring the payroll tax. Others look at adjusting benefit formulas or gradually shifting the full retirement age. A few focus on changes that would affect higher earners more significantly while protecting lower and middle INOME recipients. But here's the honest reality: none of those proposals have been enacted yet. What's been enacted are smaller, more targeted adjustments, like those provisions we discussed, and a few others that provide indirect relief. One example worth knowing about is a temporary tax deduction available to seniors for tax years 2025 through 2028. This deduction allows eligible individuals to reduce their taxable income by up to $6,000. It doesn't add money directly to your Social Security check, but it can meaningfully reduce what you owe in taxes, which for some people is equivalent to saving several hundred per year. Whether this applies to your situation depends on your total income and tax filing status. So it's worth checking with a tax professional if you're not sure. The broader point here is that the financial experience of being on Social Security in 2026 is more complicated than just one number going up. Your gross benefit may have increased. Your net deposit after Medicare premiums may feel smaller than expected. Inflation, particularly for healthcare and housing, continues to outpace the general indexes used to calculate cost of living adjustments. And many retirees report that even with increases, their actual purchasing power feels weaker today than it did a few years ago. That's not imaginary. The cost of living adjustment is calculated using indexes that are designed to reflect general consumer spending patterns. But senior households typically spend a larger share of their income on healthcare and housing, two categories where price increases have been especially steep. So the adjustment and the actual experience of prices in the real world don't always line up. This is partly why more people are choosing to continue working in some capacity while receiving benefits. In 2026, if you're under full retirement age, you can earn up to $24,180 from work before your Social Security benefits are reduced. In the calendar year when you reach full retirement age, that limit rises to $65,160. And once you've passed full retirement age, there is no earnings limit at all. You can work and receive your full benefit simultaneously. For a growing number of people, part-time work isn't just a personal preference. It's a practical strategy for closing the gap between what Social Security provides and what life actually costs. If that's a route you're considering or already taking, knowing those earnings limits is important so you don't accidentally trigger a benefit reduction. There's also a related question that comes up a lot, especially in the current environment. Does it make sense to claim benefits earlier than planned, maybe even right now, just to lock in what's available before any future changes? It's a fair question, and the honest answer is that it really does depend. Claiming early before your full retirement age permanently reduces your monthly benefit amount. For many people, that reduction can be significant and long lasting. On the other hand, waiting beyond full retirement age increases your benefit by a set percentage for every year you delay up to age 70. After that, there's no additional increase for waiting. Your health, your current financial situation, your other income sources, and your long-term plan all factor into what makes the most sense for you individually. There isn't a universal right answer. What there is, though, is real value in running the numbers specific to your situation rather than making a decision based on anxiety or incomplete information. Let's also take a moment to talk about something that unfortunately doesn't go away no matter what else is happening in the news: fraud targeting Social Security recipients. Scammers are active year round, but they tend to increase their activity around tax season and whenever there's media coverage of benefit changes. Exactly the kind of environment we're in right now. The most common tactics involve phone calls or messages claiming to be from the Social Security Administration, warning you that your number has been suspended, that you owe money, or that you need to verify your identity immediately to prevent a problem with your payments. Here is what you need to know clearly. The Social Security Administration does not call you demanding immediate action. They do not threaten you. They do not ask for payment over the phone. They do not request gift cards, wire transfers, or cryptocurrency. If you receive any contact claiming to be from Social Security that involves urgency, threats, or requests for money or personal information, of that is a scam. Hang up. Do not engage. This is especially important right now because the operational changes at the agency have created a little more confusion than usual about what legitimate contact from Social Security looks like. Use that confusion as a reason to be more careful, not less. Not, all right, let's take a step back and look at where we are heading into April 2026 with a clear head. The payment schedule is consistent and predictable this month. SSI lands on April 1st. Early recipients and those receiving both SSI and Social Security see their deposit on April 3rd. The birthday-based payments fall on April 8th, April 15th, and April 22nd, respectively. The 2.8% cost of living adjustment is now fully reflected in your payments. Though the net impact after Medicare premiums may feel smaller than the headline suggested, the elimination of the windfall elimination provision and the government pension offset is producing real tangible increases for qualifying public sector workers, sometimes substantial ones. The Social Security Administration is in the middle of a structural shift towards centralization that is creating longer wait times and less direct access to personalized help. The long-term solvency question remains unresolved, but is not an immediate crisis. It is a medium-term concern that policymakers are actively debating, and several smaller relief measures, including the senior tax deduction, provide some indirect financial benefit worth knowing about. None of this is a reason to panic, but all of it is a reason to stay informed, stay organized, and ask questions when something doesn't look right on your end. The people who navigate this system most successfully tend to be the ones who know their numbers, their payment dates, their net deposit amounts, their Medicare premium deductions, their earnings limits if applicable, and who check in on changes at least once a month rather than letting things drift, which is exactly why you're here, and that matters. If this video helped you feel more clear and more prepared, heading into April, please take a second to give it a like. It genuinely helps more people on Seniors Pathway find this kind of information when they need it. And make sure you're subscribed so you're ready when the next update comes out because the pace of change in this space is not slowing down. Stay sharp. Take care of yourself.